what is the most mean reverting market in your world? Mike Butler, go.
Implied volatility, the VIX. But you need to take that with a grain of salt, because even though implied volatility does have mean reverting properties, you are still taking directional risk in a lot of those trades. So I really like trading mean reverting markets from a pairs trading perspective now that I've learned more about them, just because you can hedge your risk more effectively and give yourself the amount of time required for hopefully that market to revert. But yeah, implied volatility is the number one thing that comes to mind for sure.
And maybe you can speak a little bit, because we're not talking about implied volatility today. We're talking mainly about futures markets, not options. What is, in 30 seconds, if you say implied volatility is mean reverting as an options trader, what does that mean? Like, what's just like a quick 30-second synopsis of like implied volatility has got a mean of, let's say, 20%. When it's at 40%, I'm doing X. When it's at 10%, I'm doing Y. Like, what does that mean reverting quality mean in the options world vis-a-vis implied volatility?
So ultimately, extrinsic value drives implied volatility. So as these option prices increase from an extrinsic value premium standpoint, that drives the implied volatility number to be higher. So in the example of like the E-mini S&Ps, typically when the E-mini S&Ps sell off in a big way, you'll see implied volatility increase, which just means that extrinsic value across the board in these option prices is increasing. A lot of people call it the fear gauge. So when you see markets collapsing, you'll see the VIX spike up, but eventually that fear goes away, whether it's through minimal movement or a rise back up in the S&Ps. That heightened implied volatility comes back down, but eventually it spikes again, but it comes back down. So it has this mean reverting kind of breathing property to it. And again, that is really speaking to the extrinsic value associated with these options, but these options still have a directional nature to them, which is why even if you're trading a more mean reverting market or a static delta mean reverting market, like currencies or other things, you still have to account for the fact that you could take on some heat in those positions, even if the probabilities are super high that it will mean revert.
Exactly right. And so in that scenario, it's like, all right, option prices increasing, they're above, implied volatility is above its mean. I'm selling options, and same theoretically on the reverse, markets not moving, implied volatility and option premiums are lower than average. I would maybe look at buying options. Now, I want to apply this to, because in the equity world, we'll see in a second, you don't see price mean reversion a lot. You do in that options piece like you talk about, but I want to take a look at foreign exchange and maybe a couple other asset classes, because you do see some price mean reversion in asset classes outside of equities. Now, you look at US dollar over the last several months and even today, actually through these highs, and it looks like this market may never come down. And you see similar trends. You look at the end of 2007 throughout all of 2008, and it's like, man, implied volatility may never come down. It's just, new high. It just keeps spiking. But when you take a step back, you look at these markets like foreign exchange or like implied volatility, when you're looking at multiple years of data, you say, oh man, like, okay, implied volatility has an average around 20 and it trades between 10 and let's say 40, give or take some outliers. And so when it's down at 10, maybe I'm buying options. When it's up at 40, I'm selling options. Same can go for price action in an asset class like US dollars, where you've got an average price in the SFX product around, 150 to 155. When it's spiking above that, like it did, at the start of the pandemic here, like it is doing now, I could look at shorts and then reeling those shorts in for potential profits when the market comes back, making money off of mean reversion that way. Now, I do want to get your take on something that doesn't really mean revert, like an equity index like the S&P, or especially you look at some of these single names like Tesla, Mikey. I mean, this is one of the toughest trades out there, is to try to sell a stock market that's going above what you think is its average price, because these stocks have just shown historically that they tend to trend. And it's not the same as trading mean reversion in the options as the stock price, like you can see here in Tesla, right?
Yeah. And this is why, even though like in these periods, like after that 2021 drop, I'm sure you saw a really heightened implied volatility in Tesla, where maybe if you were selling puts, which is a bullish trade, you're going to get that added extrinsic value with the implied volatility expanding. And you're also kind of playing into that sell-off where you're playing for a reversal in the price itself. But if you're like shorting Tesla at 200, split adjusted here, and you're expecting it to come back down, it's going to take a ton for, of course, Tesla to come back down to those pre-split levels. Like basically, they'd have to become irrelevant for that to happen, which is, it's tough. So for me, like I personally am comfortable with selling puts into sell-offs because it's paired with that reversal implication to the upside, where if I'm taking upside risk through a short call or something like that, I also want to make sure I have a short put that offsets some of that risk. Or maybe I go with a Jade Lizard that doesn't have upside risk. So I'm more cautious with taking unlimited upside risk because of this chart. And I'm much more comfortable taking unlimited downside risk because even in Tesla, you see that these sell-offs happen, but they have recovered. And if you're trading SPY or the Qs, all sell-offs have recovered over time. So it definitely depends on what product you're trading, like we're talking about here. But stocks can have especially stocks that gain momentum, like you said, and hype, they may not ever come back down to these 2020 levels.
Very true. And I'm glad that you brought up, that's a good thing to live by in stocks is one, the implied volatility mean reverts. So you can't be selling rallies or buying dips in stocks necessarily, but you can look at selling implied volatility rallies via strangles or short puts or what have you. Because every sell-off in the broad equity market has reverted back up. Yes, but actually every rally in the equity market has not reverted back because you just look at the S&P 500 priced above $4,000 relative to all the other crashes going back to 30 years. And we're nowhere near any of those highs. They just continue to blow out the highs. Now, a last piece here, because other markets that do mean revert include, commodities like crude oil, natural gas, agricultures, foreign exchanges we went over. Interest rates, another one that is ripe with mean reversion. The last thing, though, is that make sure that you're prepared for a longer term trade when looking at some of these mean reversion ideas, Mikey, because natural gas, for example, the market historically, it always comes back to average prices, to that mean at one point or another. But if you're trading too big and you're short from, even you thought you got good prices at $5 or $6 and it gets up to $7 or $8, you might get taken out before that reversion. So be prepared for a market to diverge through you before reverting in especially big markets like natural gas, right?
100%. And this is why you have to, regardless of how strong your opinion is, you have to account for being wrong. Because, more often than not, you're not going to be able to paint the top or the bottom. It's just very, very, very hard to do. So if that's the case, you need to account for variance against you. And natural gas is very volatile for a reason. And if you're not accounting for that, you're just not giving yourself that wiggle room that you need for a trade to really work out for you.
Absolutely. Well put there, Mikey. Thanks so much for joining us. Yeah, it's a funny thing because everyone always thinks like, oh, if you thought that the market could move through you, then instead of selling it, why didn't you buy it and then sell it? And it's like every time I put on a mean reverting trade, I think that I'm getting a good price. You just have to be prepared for that market to move through you. And that's why we trade small. We do defined risk spreads and options, use the small futures and everything else. Mikey, thanks so much for joining me here on Monday afternoon. Always great to have you on. Make sure that you're following Mikey on Twitter and you're also checking out his other shows here on the Tasty Trade Network. Everybody, thanks so much for watching. Splash into Futures is coming up next. You're not going to want to miss that. Stay tuned and I'll see you here tomorrow. Peace.